Hello YouTube, this is Steven with On My Way to FIRE, a channel about early retirement and all things investing. And in today's video, I want to talk about determining your risk level. And what this means is, as an investor, your money is put at risk from the minute that you make your purchase. So whether it's through a mutual fund, ETFs, or stocks, your money is now converted into a share or a portion of a share, and now the market's going to move and your money's going to go with it. So in the course of long-term investing, especially with a 401k, you're going to be building positions over years and years, and probably decades if you stay with the company, of shares of mutual funds. And within those funds, the shares are constantly fluctuating, and they're also getting rebalanced. So an index fund just mirrors the actual index that it's tied to. So you could have an S&P 500, a REIT index, small cap, mid cap, etc. So I'll provide some links here in the video. You could take a look. But I'm also going to provide a link to Investopedia that's going to give some information about determining your risk level. And what that means is, as the market fluctuates, can you tolerate losses of 5 to 10%, 10 to 20%, 20 to 30%, or maybe 50% or more? And that's going to determine what type of investor you are and what risk level you have. So I'd say in the beginning, I was more of a moderate to light risk investor, and I didn't want to lose money. And I didn't really understand the concept of the market constantly in fluctuation. I just knew that on days that I looked at Yahoo Finance or MarketWatch, that I would tend to see big red numbers. And it would scare me a little bit, thinking like, wow, why do people put their money in the market when it just only goes down? But that's just relative to that day. So as you watch things more, you'll see that things kind of slosh back and forth within a range. And then at a certain point, it'll break out and it will go one way or the other. And so what we need to keep in mind is there are corrections, and a correction is defined as something less than 10%. And let's just talk in general for like a S&P 500 fund. You'll generally get a correction about once a year or so. And it's even possible that you get more than one correction in the same year. Now, beyond that, once you start getting to a correction at 15 to 20% and it crosses over 20%, you're now in a bear market. And that just means that, for whatever index that you have, that it's down over 20%. And I've gone through a number of periods over the last 15 years that I've watched, but I participated probably more so in the last 12 years. And I would say 2015, that was a really tough year. 2020 was a tough year, and 2022 was a really tough year. And even in between these periods and going into last year, we had periods where we were up consistently for a couple quarters, and then you just backtrack. And what it taught me was that my consistent investing in my 401k was constantly buying in intervals over all those months and just averaging in. And you're getting prices that are different, but at the same time, it's smoothing out the return because you have to wait out for the fund to come back. And it really tests your patience in terms of what you're willing to look at. And if you don't have a good centering within yourself to tolerate that, you'll sell things at a loss, wait things out, and then you'll see the market recovering right after you sold, because that's how these things tend to work. It happens right after you sell. But anyway, it could happen a few months later, it could happen a year later. But a lot of these indexes will start coming back, and then now you're out of the fund with reduced amount of shares or out completely, and now you want to buy back because you see that it's high, and now you might even be buying at a market top. So a good example of this would be just even recently, as of this last February and March, the market started going down. And if you sold at that time during a mini correction, because I don't think we crossed over a 10% negative number for the S&P 500, but it was down about 7-8%, something like that. And if you sold at that time and then you didn't get back in before the end of March, the market completely recovered all those losses and then some. So it's a frustrating thing to try to time the market. So, in my time of investing and kind of just learning how these indexes move back and forth relative to interest rate policy, politics, all the things in the world that are going on, you have to just really be mindful and hold your ground. That's really the way I see it. I don't sell in desperation or based off emotion. And I think that's helped me to really grow my account just in ways that I just never thought it was even possible. And in one of my videos, I talked about the myths of investing, and I just didn't understand how you could make over 30% a year in a certain fund or stock. But it's definitely possible. But you have to be willing to continue to buy during these down periods. And a lot of this comes down to, for me, not lump sum investing. And that means not dumping in thousands and thousands of dollars at one time. I'm constantly buying in waves. And so paycheck contributions every 2 weeks, I'm purchasing in my 401k. That's smoothing out the return. You're buying through all different periods of the year. And when you have a couple years in a row that go up, those gains compound. And conversely, when you have a period where the market's down, it's doing the buys at that time, and you have to wait it out for the market to come back. So that leads to something called sequence of returns risk, and that's where you retire into a market that's going down and you're taking withdrawals at the same time. So what's happening is your account overall is going down, and it doesn't have a chance to recover as much because you start selling the shares that you have within the portfolio, and it really can hurt you in the long term. So in determining risk level for myself, I started off with preferred stocks, which I thought were relatively safe. And in the beginning they were, but interest rate policy in the year 2022, with the number of increases in the federal funds rates through the Federal Reserve, it caused those stocks just to crash. And I would say they were down about 30 to 35%, and they still haven't fully recovered really. But I'm slowly starting to buy back into these because I think they've flatlined. They're not really going to go up as much, but they're not going to go down as much either. And I'm getting a yield about 5.5 to 6%. So I'm just basically treating it like a certificate of deposit and waiting it out to see if we can get a rally when the rates do actually come down, but it's going to take a while. So that's what I'm talking about understanding interest rate policy relative to things that you're buying, and recentering to myself just to say, hey, I'm not expecting the stock to make 50% or 100% in the next couple years. Preferred stocks are just like income funds. And, if I get a little bit of a rally of somewhere between 10 and 20%, that's really all I'm looking for. But it might take 2 to 3 years to get that. So, none of this is financial advice. This is just the way I look at it. But that gives me more confidence to buy things when they're down. And I think that's really the name of the game when I'm investing. It's finding the best use of funds at each time, given how much cash I have available and what kind of obligations I have in terms of bills. Like I've mentioned before, property tax and insurance are my two biggest bills outside of my home loan that I have to pay, and just all my other regular bills. But it's really about determining cash flow, getting that in order, and having the extra money to put into different funds. And the big thing for me over the last 10 years really has just been realizing that even $30 or $50 at a time, when you do it multiple times throughout a month, I'm talking just a couple $100, $200, $300. It's amazing what the returns can be if you're just consistent with doing it. And another thing I'll add here with risk level, certain things that I thought were safe, they went down over 25, 35%. It's quite shocking when you think of a stable company, but again, this is a single stock, and it could be sector based, or it could be just in general for the actual stock itself having bad earnings. You don't really know what's going to happen. And so what I like to do is let it play out. And if it's going to go down 30%, I don't make an immediate decision to buy more right away. I kind of just hang back and just keep watching. And as new money comes in through other dividends and other investments that I have, maybe capital gains when I sell, I'll start buying again, $30 to $50 at a time. And if I have the cash, I'll start buying a few shares and start doing it to a couple $100. But I don't go crazy with it, and I do it spaced out. And it gives me some peace of mind because I'm not stressing myself out over the day-to-day movement. I'm looking at it more of what's the stock doing over the last couple weeks, last couple months, and the last year. And that's really helped me with my investing to just hang back and not get anxious with what the market does. So I'm hoping this video can help you, determine your risk level. I'd say at the low end, you'd be looking at things like a high yield savings account or a CD. Those are pretty much guaranteed rates that you'll earn, but it's not really going to break out and earn anything. So a typical investor that might be light risk to conservative might just go with those things because they do not want to lose the money and they need it. And that's perfectly fine. You got to find the right balance that works for you. But typically, what a lot of people aim for is what's called a 60-40 portfolio, where you invest in bonds at 40% and stocks at 60%. Personally, I do not like bonds. I have purchased them over the years, but I've seen what they've done, and they continually go down, and more or less the interest rate that you're getting is quite similar or almost equal to the amount that you could get just holding it in the portfolio as cash. So why would I want to lock it up in a bond fund that can constantly go down? And a lot of that comes down to long-term bonds in the last 10 years just have not performed very well. And a bond fund has multiple types of bonds in it. It's too complicated for me to understand, and I personally just do not like it. So I'm gonna leave some links here, and hopefully you get some good information. If you enjoyed this video, please give me a thumbs up, and I'll see you in the next video.